Who really controls the money you use every day? Is it the government, your local bank, or is there a more powerful hidden hand at play? Today, we're pulling back the curtain on one of the most powerful and mysterious institutions in the world, the Federal Reserve. This isn't just a story about numbers and interest rates. It's a story about power, influence, and who truly benefits from the system that underpins the global economy. So, buckle up, because we're about to embark on a journey through the financial history of the Fed. To understand the Federal Reserve, we have to travel back to the early 20th century. Before 1913, the United States had a volatile financial system. Bank runs were common, and financial panics could wipe out fortunes overnight. The country had tried central banking twice before, but both attempts were met with deep suspicion and ultimately failed. Many Americans, especially farmers and small business owners, feared a centralized bank would concentrate power in the hands of a wealthy elite, far from the concerns of ordinary people. Then came the Panic of 1907. It was a severe financial crisis that nearly brought the entire American economy to its knees. The stock market crashed, banks failed, and it was only through the private intervention of J.P. Morgan, one of the wealthiest men in the world at the time, that the system was saved. He personally organized a bailout, using his own capital and convincing other bankers to do the same. This event, while showcasing the power of one man, also highlighted a massive problem. The nation's financial stability couldn't rely on the whims of a single private citizen. The call for a more stable, centralized system grew louder. This is where the story gets really interesting. In November 1910, a group of the nation's most powerful financiers gathered for a secret meeting. Under the guise of a duck-hunting trip, Senator Nelson Aldrich, along with representatives from the Rockefeller and Morgan banking empires, convened on Jekyll Island off the coast of Georgia. For 10 days, they worked in absolute secrecy to draft a plan for a new central banking system. They were so concerned about secrecy that they used only first names to avoid being identified by the resort staff. The plan they created, known as the Aldrich Plan, would become the blueprint for the Federal Reserve Act. Now, why the secrecy? Because the public was deeply suspicious of Wall Street. If it were known that the country's biggest bankers were designing the new central bank, the plan would have been dead on arrival. The idea was to create an institution that appeared to be public and governmental, but was structured to protect the interests of the banking industry. The Aldrich Plan was initially defeated in Congress, precisely because of its association with big banking interests. But the idea didn't die. Democrats, led by President Woodrow Wilson, repackaged the concept. They made some modifications to give it more of a public-facing appearance, creating a system of 12 regional reserve banks to decentralize power, at least on the surface. They called it the Federal Reserve Act. It was cleverly framed as a way to wrestle control away from the Wall Street money trust. On December 23, 1913, with many members of Congress already home for the Christmas holiday, the Federal Reserve Act was passed and signed into law. The United States had its third central bank. So, how does the Fed actually work? It's often described as a quasi-public institution. It has a board of governors in Washington, D.C., whose members are appointed by the President and confirmed by the Senate, giving it a public face. But the real operational power lies within the 12 regional Federal Reserve banks. And here's the catch. These regional banks are privately owned by the member banks in their district. That's right. The commercial banks in your area, the ones you bank with, are the shareholders of their regional Fed. They receive a fixed 6% dividend on their shares each year. So, while the Fed's chairman might testify before Congress, the underlying structure is a partnership between the government and private banking interests. The Fed was created with a dual mandate: to maintain price stability and to maximize employment. Its primary tool for achieving this is control over the money supply and interest rates. When the economy is slow, the Fed can lower interest rates to encourage borrowing and spending. When inflation gets too high, it can raise interest rates to cool things down. This is the macro power we talked about earlier. The decisions made in a single room can affect the price of your mortgage, the availability of car loans, and even whether you have a job. This leads us to the big question: who really benefits? Proponents of the Fed argue that everyone benefits. A stable financial system prevents the catastrophic panics of the past. By managing inflation and unemployment, the Fed creates a predictable economic environment where businesses can grow and people can prosper. They point to the century of economic growth since the Fed's creation as evidence of its success. Without a central bank, they argue, we'd be at the mercy of boom and bust cycles that hurt the most vulnerable. However, critics paint a very different picture. They argue that the primary beneficiaries are the large commercial banks and the government itself. How? Let's start with the banks. The Fed acts as a lender of last resort, and this means that if a large bank makes risky bets and gets into trouble, the Fed can step in with low-interest loans to bail them out, protecting them from failure. This creates what's known as moral hazard. If banks know they'll be saved, they have an incentive to take on more risk than they otherwise would. This safety net isn't available to you or me, but it's a cornerstone for the big players. Furthermore, the Fed's ability to create money out of thin air, a process known as quantitative easing, has been a major point of contention. When the Fed buys government bonds and other assets, it injects new money into the financial system. This new money tends to flow first to the financial markets, driving up the prices of stocks and bonds. Who owns the majority of these assets? The wealthy. So, while the average person might not see a direct benefit, those with significant investment portfolios see their wealth grow. This is a key driver of wealth inequality. And what about the government? The Fed is the government's biggest enabler. By keeping interest rates low and buying up government debt, the Fed makes it easier for the government to spend more than it takes in through taxes. This allows for massive deficit spending on everything from social programs to military budgets. Without the Fed to finance this debt, the government would have to make much harder choices, either by raising taxes significantly or cutting spending drastically. In essence, the Fed allows the party in Washington to continue without immediate consequence. The real cost of this system, critics argue, is borne by the average citizen through inflation. When the Fed creates more money, each existing dollar loses some of its purchasing power. It's a hidden tax. Your savings are worth less and the cost of living goes up. While your wages might increase, they often don't keep pace with the real rate of inflation, especially for necessities like food, housing, and energy. So, while the system creates wealth for those at the top and enables government spending, it can slowly erode the financial security of the middle and lower classes. Think about it. From the secret meeting on Jekyll Island to the bailouts of 2008 and the massive money creation during the 2020 pandemic, the story of the Fed is one of powerful interests shaping the economy for their benefit. It's an institution born of a crisis, designed in secret by bankers, and given the incredible power to create money. This power allows it to influence every aspect of our economic lives, deciding who wins and who loses. So, the next time you hear the Fed chairman on the news talking about interest rates, remember the history. Remember the men who met in secret to design this system. And ask yourself, is this system truly working for everyone? Or is it primarily a machine that benefits the powerful, the connected, and the government it serves? The control of money is the ultimate control. Understanding who holds that power is the first step to understanding the world we live in. Thank you so much for watching. This is a complex topic, and we've only scratched the surface. What are your thoughts on the Federal Reserve? Let me know in the comments below. And if you found this video insightful, please hit that like button and subscribe for more deep dives into the systems that shape our world. We'll see you in the next one.